Before I understood options trading, I was basically gambling my money away. And the only thing that changed was learning how to properly read options and go back to the basics and actually have a good foundation to my trading. Last month alone, I made $80,000 swing trading options. So I can tell you it definitely works. You just have to do it the right way. But only if you learn the fundamentals and slowly but steadily apply them over time is when things are really going to click. Because the reality is, even if you're trying to make trading just an income or a side hobby to generate that income, you still need to do things the right way and learn the fundamentals of trading. But you can't get stuck in the learning phase literally the whole time you're trying to get into options. You have to apply stuff into the real markets. So you need to educate yourself properly and apply what you've learned immediately onto the live markets. When I started 6 years ago, I was basically just gambling my money away and I did not learn how to trade properly. And 2 years in is when I really sat myself down and I told myself, okay, I have to learn how to do this the right way or else I'm never going to be able to do this for a living. I wish I had a comprehensive breakdown like this when I first started, but I'm about to show you basically everything I've learned over the last 6 years of trading. In this video, I'm going to cover everything a beginner needs to know about options trading, the terminologies, the strategies you need to follow, and also the risk management. That way you avoid blowing up your account. If you're looking to become a better and complete trader and actually turn profitable, this is your complete roadmap to options trading. Let's get started. Let me start with what most people miss out about options traders. Most traders fail because their approach to options is literally like a casino. They think it's gambling, they think that they're betting on either sides, but that's not the way to approach option trading, and all that's going to do is blow your money very quickly and just keep you in that same repeatable cycle of losing and losing and losing. I would plant myself in front of multiple screens, jumping in and out of trades whenever I saw a setup, thinking that that was going to make me a ton of money, but it just did the opposite. It made me someone who was prone to over trading, revenge trading, and not following a system that was actually profitable. The only difference between profitable traders and unprofitable traders is a system, an edge, and discipline. And without those three things, you'll never become profitable. And that's the hard truth. Because the reality with options trading is if you can't control yourself and your emotions, all you're going to be doing is basically just gambling. It's like going to a casino. It's like sports betting. So let's begin with the video. First off, what exactly are options? Well, options are contracts that basically give you the right, but not the obligation to buy or sell a underlying asset at a specific price with a specific time frame. So that's going to be your expiration, and that price is going to be your strike price. Each contract controls 100 shares of the underlying stocks, which basically gives you leverage to control large positions with relatively small capital. And this is why I'm such a big fan of options, because you could take very small risks and make a ton of money because you have so much leverage. The issue that many traders have is they'll take too big of a risk, think that that's going to be something that's going to get them rich quick, and then end up blowing everything. But if you could do it this right way, you're going to be able to actually take really calculated risks by risking a small amount of money and being able to turn these like profits into huge profits. Options are also super versatile. A lot of people think all you can do is like bet up and down on stocks. No, you could actually hedge yourself against, market downfall. If you're long in your investment portfolio, you can hedge the markets coming down, and you could also sell options to create an income, generate money by selling the options and collecting the premiums. The key advantage though to options is the leverage. A simple 1 to 2% move in the stock could literally net you over 100 to 200 to 300% in profits, while an underlying move on the stock is only going to give you 1 to 2% if you were just buying the underlying of the stock or shorting the stock. So the returns are absolutely exponential, but that is why it's a double-edged sword. You can actually get destroyed very quickly, or you can do it the right way and make money over a long period of time the correct way. Before we go any further, let's break down the essential vocabulary you need to know. So first of all, the options contract is going to be an agreement between buyer and seller. The call option is going to be the right to buy shares at a specific price. A put option is going to be the right to sell shares at a specific price. A strike price is going to be the price at which you can buy or sell. And then the premium is what you pay to purchase the option. The expiration date is when your rights expire. So for example, you're going to have, let's say, a 50 call, which is going to be the strike price at a expiration of April 17th, which is when the contract will expire. So you have the right to buy that stock at $50 a share by the time the contract expires, as long as the stock is above that strike price. And these three terms describe where an option stands relative to the stock price. The first one is going to be in the money when the option has intrinsic value. So for calls, when the stock is above the strike price, and for puts, when the stock price is below the strike price. Out of the money is going to mean when the option has no intrinsic value yet. So for calls, that's when the stock price is going to be below the strike price, and for puts, when the stock price is above the strike price. At the money is when the strike price equals market price, basically right at the money, right at that level that the stock is at, is where your strike price is. Understanding these terms is going to be absolutely crucial to becoming a better options trader. Now, let's talk about the primary types of options. The first one is going to be a call option that gives you the right to buy shares. You profit when the stock goes up. So this is basically a strategy we use when we think a stock is going to go up and the charts are telling us that things are going to continue to the upside and we're making an upside bet. Now, the next one is going to be a put option. This is going to give you the right to sell shares and you can profit when the stock goes down. Now, you don't necessarily have to exercise the options because at the end of the expiration, technically someone has to buy or sell those shares if the strike price is in the money. However, that doesn't necessarily have to be you. You could just sell the option for a profit by buying it at a cheaper price. And then as the premium increases, when the stock goes in your favor, you're going to collect that difference in premium and sell it to somebody else as a more expensive premium. So too many people think that you actually have to exercise the options, but we're just trying to collect the difference between when we buy the option and when we sell the option, and obviously try to sell that at a more expensive price as the option's value goes towards our strike price. Let me show you how a real life example works on the stock Palantir. So let's say you wanted to buy the stock at $93.78 and you wanted to buy 100 shares. That would be about $9,300 they would have to spend to acquire those 100 shares. Let's say you think the stock is going to rise over the next 30 days. Instead, what you can do of buying the shares, you can buy a call option. So you could buy the call option at $100 for the stock that is expiring in 30 days. And you're basically going to pay a premium for that call option. That's going to be about $2. Now, since the stock obviously controls 100 shares for the options contract, you're going to be paying $200 for that contract. Now, if Palantir rises to $105 by the expiration, so that's in 30 days from when you bought the call, basically your call option is going to give you the right to buy 100 shares at $100. The market price is 105, so that's a $5 share advantage. $5 times 100 shares, that's going to be $500 of profit. Now, also you have to minus obviously how much you paid for that call option, which is going to be $200, but you collect that difference. So you're going to have a $500 advantage. You paid $200. That means you collect $300 in premium. That's a 150% return on your $200. Compare that to buying shares directly. The stock went from $93.78 to $105. So you would have made about $1,100 on that difference, but you would have had to pay $9,300 investment just to get into those 100 shares. That would have only been a 10% return versus the 150% return on the option. Now, the leverage is what makes the option so powerful. But remember, if Palantir would have stayed under $100 by expiration, you would have lost all of those $200 that you paid for that call option because it would have expired worthless. Now, another common misconception is that you have to hold options until expiration. This is totally not true, and the contract value will actually increase as price gets closer to the strike price, but it doesn't have to take all the way up to expiration. So let's say you have 30 days for the stock to move within your direction. It can move the next 2 days all the way up to $100 and you would still make a ton of money. It doesn't have to be until the end of the expiration. That's just how much time you have until the call expires worthless if you're out the money. But if you get in the money quicker, now you're going to be making more and more and more money faster because you're going to be able to hold on to that time decay that you would have got hit with if you would have held for longer. So the number one pro tip that I give many traders when they're first starting with options is to be able to trade things quicker. You don't want to hold options for too long like common stock because options do have that time decay. Now, we can buy more and more time. So we could buy 2 months out, 3 months out, 6 months out, but we want to be able to get that move as quick as possible because if we can get the move before the 6 months, we're going to make more money because we're going to be able to keep that time premium that we are paying for. The more time you buy on options, the more premium you're paying for time. So think about if a stock has 1 week out, but now it's in the money after 1 day and you didn't have to wait that 1 week, you're going to be able to sell it that next day, but you're also going to have that money that you're making on the actual premium of the contract and the time that the contract has left until expiration. So now let's say instead of being only up $500 when the stock hits 105, let's say it hit it 15 days before the expiration. Now you're going to even have more value for that contract because it has time. So now it might even be worth $700, $800, $1,000, right? So the whole goal is to be able to get these moves quicker and be wrong very, very quick with options. You don't want to be wrong over a long period of time because you're going to be able to lose all that time decay and then you're going to dig yourself a pretty big hole if you don't cut your options quick. Buying versus selling options. There are two sides to every single options trade, a buy and then a sell. So for every single person that buys an options contract, somebody else is selling them a contract. When you buy options, you pay the premium up front. Your loss is limited to that premium. Your potential gain is theoretically unlimited with calls, and you need to be right about the direction and timing. Now, when you sell options, you collect the premium up front. So instead of paying the premium, you're collecting the premium. You have a higher probability of profit because remember, 90% of options do expire worthless. So we limit our downside with buying naked options, but if you sell naked options, you actually have unlimited downside. So we want to be a little bit careful with selling options. I would prefer to buy naked options first, and then once I learn how to actually do that properly, get into potentially selling premium and collecting premium on the side. You also profit with time decay when you're selling the options because you actually want the options to expire worthless as opposed to being in the money as you are buying calls. Here's what most beginners miss though. The quality of your trades matters much more than the quantity. So we want to be right, obviously, as much as possible, but that means choosing the right setups and waiting for the right times to trade within the market, specifically with options. And I can't express how important this is because if you take trades that are really, really bad with options and times in the market when things aren't setting up, all you're going to do is be getting that time decay and basically fighting against the current of the options. A sniper with one perfect shot is way more effective than someone spraying a bunch of bullets hoping to hit something. The most successful traders I know aren't taking 20 trades a day. They're waiting for the perfect setups and the right times to strike within the markets, especially with options. Some days I won't even trade more than 1 or 2 trades a day or even take no trades. Sometimes there's weeks where I trade 4 to 7 times and maybe sometimes even less than that. Now let's talk about what affects the options prices. There are 5 main factors known as the Greeks. These are super important and too many people skip out on actually learning these correctly and then they're confused as to why their options move the way that they move. So the first and most important, in my opinion, is going to be the delta. So this is going to be 0 to 1, and it's going to show you how much the option price moves with the stock. So let's say the delta is at 0.40. For every dollar a stock moves up and down, that is how much you're going to make. So if the stock moves up $1, you're going to make $40 on your contracts. If the stock goes down $1, you're going to lose $40 on your contracts. Now, the next one is going to be the gamma. This is going to be the rate of change of the delta. So it's going to be correlated directly to the delta, and it's going to show you for every dollar a stock moves, how much the delta is going to gain in value or lose in value. So actually, the delta can change. So you can make more money as the stock is moving up, and you can lose more money as the stock is moving down if you have, let's say, a call option. So this is why it's important to know how much the gamma is to be able to see how much you're going to make if the stock continues to go in your direction. So if the stock moves $1 and you made $40, now the delta, let's say, is going to be 50 because the gamma was 10. So you're going to get an increase of 10 cents per the dollar of the stock moving in the direction of the call option that you traded. The next one, and this one is just as important as the delta, is going to be the time decay known as theta. This is going to be the enemy of options traders. Not a lot of people really dive deep into theta and understand exactly how options move, but the time decay is what really kills your contracts. A lot of traders will look at a stock, it'll go sideways for a few days, and they'll wonder and look at their broker and be like, why am I down money on my options when the stock hasn't even moved? This is because you're fighting against time decay. Every single day, the contract is losing value, and the theta is going to be the value of how much you're going to lose every single day as long as you hold that contract. So let's say if the theta is 20 cents, you're basically going to lose $20 every single day as long as you hold the contract, and that theta continues and continues and continues to get higher as you get closer to the expiration. Now, this is going to be an important factor because if you look at your delta and your theta, you actually want to know how much you need the stock to move in terms of the delta to be able to undercut that theta and to sustain, the option decaying every single day. So if your theta is, let's say, 20 cents, you need maybe the stock to move about $1 a day to be able to even, defeat that theta that is kind of gaining in on your contracts. Now, the next thing that's going to be important and that not many traders know about is going to be the implied volatility. The implied volatility basically tells you how much the markets expect the stock to move in that significant period between the expiration. So usually what happens is when there's events, when there's data, when there's news that's about to be released, the implied volatility is going to be much higher on that option because traders and the markets are expecting that stock to move much more. So you might have been caught in a trade where you were in a stock and the implied volatility was very, very high. You bought the option and then the next day an event happened, let's say for example, like earnings, and your stock went up near your strike price, but you actually lost a ton of value. That is called an IV crush. Basically, what happens is the implied volatility gets crushed because the news event, the earnings, whatever that is happening within the markets gets announced, and then all the implied volatility that you bought within the premium gets crushed, and all that value gets deducted off of your options contract. Even if you moved in the right direction and the stock ended up moving closer to where your strike price is, or even in the money, you still lost a lot of that value off the implied volatility. And last but not least, the Vega is going to be your sensitivity to volatility. So it's actually going to tell you how much you're going to gain and how much you're going to lose when the implied volatility moves up and down. So this is how much an option price changes when the implied volatility changes. So let's say the implied volatility is 100%. If the implied volatility goes up to 101%, now the Vega is going to show you how much you're going to gain on the options contract. If the implied volatility goes down 1%, let's say to 99%, now you're going to know how much you're going to lose on the value of your contract by looking at the Vega. So this is why it's so important to buy contracts as a stock is making a really big move, because we don't want to overpay once the move is actually done, right? A lot of people end up chasing contracts, they end up chasing options, and with options more so than even stocks, chasing is the worst thing that you could do because you're buying a high implied volatility option that is very, very overpriced already, and the stock is also very, very extended from where the move that was made was. So not having FOMO is definitely a key that you should have within your option trading. And we want to make sure we never FOMO any trade. Understanding these gives you a major advantage over 90% of option trader, because most people that trade options, they don't even know or understand how these Greeks affect their options prices. They just think if the stock goes up, it's good. If the stock goes down, it's bad. Well, yeah, in a sense, but obviously there's going to be way more more that goes into options, and understanding how to read options the right way is really going to be game changing for you as a trader. So here's a few strategies for beginners and strategies that I personally started to use as a trader trading options after my second year to become profitable. So these are going to be high probability strategies, perfect for beginners. The first one is going to be the long call. This is when you expect a stock to rise, right? You buy a call option, profit from upward movement, limited risk, unlimited potential reward. The whole goal with long call options is to be able to risk a small amount of money to make a big amount of money because we're taking advantage of the leverage. Now, you want to have a nice trade setup as you are taking these calls. You want things to be tight and you want them to be ready to break out and make a big move to the upside. The next thing you could do is play a long put. So for example, when the markets are moving down, when things are more bearish, when the economy is weaker, we can expect stocks to fall. So we can buy a put option and profit from the downward movement. And this has obviously limited risk and a substantial potential reward. When things move very fast lower, there's a lot of panic in the markets. You can actually make a ton of money by trading these put options. The next one is going to be the covered call. This is when you own shares and want to generate income. You own 100 shares of a stock and you sell a call against those shares. You're going to be collecting the premium of those calls up front, and it caps potential upside but enhances the returns. Risk management and options. This is going to be the most important part of this video, so make sure to listen up closely. People do not blow up their account because they take the wrong stocks or they take the wrong trades. They blow up their account because they don't have proper risk management, and this is why option trading can be such a double-edged sword if you do things incorrectly. So we want to learn the correct foundation and apply the correct risk management into our trades. That way, we're able to use options as a vehicle to expand our money rather than just gamble it away and eventually have it just completely wither away, because that is what happens when you do options the wrong way. Here's how I manage my risk with options. I never take more than 3 to 5% of my account per trade, and I never risk more than 30% of the total position. That comes out to about 1 to 1.5% of the total account. Now, this is pretty aggressive to some. Some it might be smaller size, but I think that this is the kind of right approach to this, right? You can have smaller sizing, but we don't want to go over this size. If we take too much size, we're going to be putting ourselves in an over leveraged position where anything could happen. You could have news come out, you could have a gap overnight if you're swing trading, and then your position just goes to zero, because options can go to zero very, very quickly. Unlike common stocks, where being able to have bigger positions is going to be much easier to manage the risk. So your sizing is going to be probably one of the most important things. And again, remember, we don't need that much size to be able to catch big winners, because the whole idea is options have so much leverage that we could just use a small amount of money to make a large amount of money in the future. The next thing you want to do is define what your exit strategy is going to be. Know exactly where your stop loss is going to be. Know exactly where your targets are going to be. This way, if the stock market goes against you and the option that you're playing goes against you, you know exactly what you risk and you know where to stop out of that trade and when to get out of that trade and when to accept that you are wrong. On the other hand, you also know when to accept you are right. You know exactly when to take profits. If a stock hits your target level, that is going to be your exit for your profits. Now, we also don't want to get to the point where we're greedy and don't take profits as the stock is moving up. So we need to have a predefined exit and stop loss levels. That way we know exactly where to take profits and exactly where to stop out of the trade if it does end up going against us. The third thing is trade less and profit more, meaning we want to be in the best positions in the market. We want to only take the best trades out there, specifically with options. If you get into too many trades and you get chopped up in the market as the market is going sideways, all that's going to happen is you're going to be giving the market makers a bunch of free premium, right? We talked about how you could sell calls. They sell you the call, they collect the premium if that option goes to zero. They're basically collecting your boredom trading. Now, if we do options trading the right way, we wait for the best setups, we wait for the market to be moving the most when you're getting expansion from volatility. That is when you're going to have the best opportunities for options trading. The last thing is to document every single trade. If you don't know what you did right, if you don't know what you did wrong within your trade, you're not actually learning the things that you're doing correct. You're not actually improving. All you're doing is thinking you're improving, but then you're going to continue to make the same bad mistakes, and you can't capitalize on the good things you've been doing. So journal every single one of your trades. It should look something like this. If you can have something like this on your screen, it will help you understand why you got into the trade, why everything went right, why everything went wrong potentially on that trade, and you're able to get a better idea on all the things that you did within that trade and how to manage your risk appropriately for the next trade as well. So this is how my trading journal looks. You can see right here, this is a trade that I took on the day today. I had a breakout of this tight base here on the daily time frame. I bought it as it was breaking out on the daily right here with a ton of volume. You can see I have my exact net P&L. I have the exact size that I took, the net ROI. I know exactly everything about this trade, the average entry, and then I can go in here and select some of the things that I was looking for. For example, I can select the type of setup that I'm taking. I can put notes for the setup, so I can put exactly what setup I was watching, so you can see chart setting up on the daily with a very tight moving averages. I know exactly why I took the exit, and I know exactly what went right and what went wrong. So always make sure to journal your trades, go back, see what you did right, see what you did wrong. That way you can continue to do the things that you're doing right and avoid the things that you're doing wrong. When I forced myself to limit the amount of time that I trade during the day is when I actually started to see consistent profits within the market. Why? Because the more you sit on charts throughout the day during market open, the more chances are that you're going to overtrade, you're going to take bad trades, you're going to get bored and make mistakes, and you're going to get very, very emotional. So unlike anything else in life, trading is different, specifically options trading. Trading less almost always equals to more profits because we don't have to be forcing a lot of trades that are not there. We want to be only taking the best setups and making sure that those setups match our criterias and match our checklists. Now that we know all the proper steps we need to take to make sure we are risk managed when trading options, we can actually get into the options chain. So the options chain will look something like this on your broker. Obviously, every single broker is different. I'm using the broker Webull. So you're going to have your expiration dates right here. Now remember what the expiration dates are. This is basically when the contract expires. So this is when you have the right to buy those shares or sell those shares at the strike price. And this is how much time you have left until expiration. So you can see it right here on your broker, it'll display all that. So you have the 25th of April, you have the 2nd of May, you have the 9th of May, 16th of May, and it runs all the way down to January 15th, 2027. Now, one more thing to note is expirations go by either weekly expirations or OPEX expirations. On your broker, a lot of time, it'll signify if the expiration is a weekly or if it's an OPEX expiration. If there is a W next to your expiration, that means it's a weekly expiration. These are usually present on the same month. So for example, if we're trading like around April or May, they're going to have weekly options, but you can see down here until like June, July, they haven't added the weekly options yet. The OPEX expirations are going to basically be the expirations of the third Friday of each month. So for example, in April, it was the 17th of April, which was the third Friday of April. You could see for May, it's going to be the 16th. These are basically going to be the expirations with the most liquidity, because if you go out and trade this expiry in June now, you're not going to have the weeklies yet until later on. So this is going to be the most liquid expiration. And this is usually the expiration I want to target when I'm choosing my options. So once you choose an expiration, for this example, we'll take the May 16th expiration. We have this kind of chart pulled up. Now, don't be afraid, right? This is a lot of information, but it's very easy to decipher, and we only want a few specific things on our chart, specifically the stuff that we talked about. So the first thing you're going to see is the strike price right here. The strike price is going to be that price that we can either buy or sell the shares at. Next thing we're going to see is looking at calls or looking at puts. So on the left side is usually where the calls are. The right side is going to be puts. So remember, calls give us the right to buy a specific stock. So for example, we're on the ticker HIMS at a certain strike price. So the strike price is going to be in the middle right here. And then puts give us the right to sell. And it's basically going to be a downside bet. Now we can go over to the actual price of the contract. You could see right here, you have the bid, and right here you have the ask. The bid is basically the lowest price someone is willing to buy this contract at. So the lowest price someone is willing to put a bet in on the contract, to buy in on the contract. And the ask is the lowest someone is willing to sell it at this point right now. However, a lot of times you can click on a specific options and you could buy what's called the mid. The mid is basically going to be in between the bid and the ask. So the mid portion between the bid and the ask, it basically covers that spread. And a lot of times you'll be able to get filled at the mid versus needing to get filled at the ask or the bid if you're selling the option call. So try to get filled at the mid. If you're trying to get filled very quickly, let's say on a breakout trade, then you could look to get filled at market price, which is going to be the ask. But most of the times you can get filled at the mid. And then the next thing is going to be the last price right here, which tells you the last price that someone bought the contract for. So for example, you could see the ask is 7.05, but someone actually was able to buy the contract at $6.80 right here. So they actually bought it a little bit cheaper than the ask. That would probably be closer to the mid. The two other things you want to pay attention to are going to be the volume right here and the open interest. If you don't have a lot of open interest in volume, what that means is the contract is illiquid. A good rule of thumb that I use for my options is we need at least over 100 open interest. So you can see right here, for example, this call 25.5 has a 24 open interest. I usually look for over 100 at about 450 would be perfect for this 26 strike. And the next thing is going to be the volume. This is how many contracts were traded during the day. And you can see right here, we have about 208 for the 26 call. That would be close to what I look for. Usually I like to look for even more volume, somewhere around 500, but this would be enough. The reason why we want volume and we want open interest is because we want the contract to have a lot of liquidity. If the contract is not liquid, there's not a lot of volume and there's not a lot of people trading it, what's going to happen is the spreads between the bid and the ask are going to be very wide. And then you're going to have to cover it all the way from this side to this side and pay that premium in between to be able to cover that spread. When the spread is really low, you're actually able to get a very small bid ask kind of spread, and you're able to only cover it with like maybe 1 to 2% kind of extra from where the bid is. Also, when you're selling the contract, it's going to be much easier to get out of the contract at a fair price whenever there's a lot of liquidity, whenever there's a lot of volume on that contract. The next thing is going to be the implied volatility. We talked about this a little bit, but it's going to tell you the exact volatility of how much the market expects this stock to move until expiration. You can see the volatility right here is 113% on these contracts. Some contracts have a little bit more IV, and this would correlate to our Greeks that are right here on the top left tab right here. So this is how you're going to be able to see all the Greeks and all the expirations and everything you need to know about options. So if you ever wondered which options you should be choosing to be able to take your trades, I'm going to show you a little trick that I personally use to choose options and the way that I look to choose options. So the first thing I do is I like to trade slightly out the money contracts. What that means is you could see right here, this line is going to be in the money. So anything below it is out the money. Anything above is in the money for calls, right? So I look to take contracts that are slightly out the money when trading calls, and then obviously out the money the other way when trading puts. So it's going to look something like this. I like to take maybe the 26 call, the 27 call. The most important thing is it has a lot of OI and a lot of open interest. So for example, you could see on the 27 call right here, we have a good amount of open interest and a good amount of volume. So I would be favoring this call right here rather than this 26 call, because this one has less open interest and volume. But the next thing I'll do is I'll have to confirm that the delta and theta make sense. So what I usually look for is you can see the delta is going to be right here. The delta must be above 0.25. If it's below 0.25, that means it's too far out the money most of the time. So you can see right here, the delta is about 0.51 on this 27 call. That's exactly perfect. I usually like to look for somewhere around the 40 to 50 range. That's going to be kind of my sweet spot. Now, you usually want the theta to be lower than the delta. Now, it's not going to happen every single time because sometimes the contracts are going to be very expensive. And since the delta is capped at $1 and the theta can go beyond $1, sometimes the theta is going to be over the delta. But most of the times when trading inexpensive stocks and contracts that are below, let's say $400 to $500 a piece, that is what you usually want to look for in your contracts. Now, the next thing is going to be looking at the actual trade you're going to take. So knowing how big a base that you're looking to trade is going to be very important to giving us an idea of how much time you're going to need for the contracts you're going to trade. So for example, you could see we have a base here on Costco. Let's say I wanted to play calls on Costco because I think if it breaks out of this base, it's going to reach these highs right here. So what I would do is use this tool on tradingview.com, which helps you measure the range of the base. So you can do something like this, and then you could see this whole base from left to right as about 46 days of consolidation. It tells you right here exactly how many days there are, meaning I would usually like to take at least about half of the consolidation to have enough time for the whole trade to play out. So 46 days means I would want to at least take about 3 to 4 weeks of contracts to be able to have enough time for this whole trade to play out. So for this ticker Costco, we can go back to our broker. We can type in the ticker Costco, and then we can pull up the options chain right here. I said about 3 to 4 weeks, so that's going to be around May 16th. Remember, we want to take the OPEX expiration because it's going to have the most liquidity. So we can click on that one right there. And then now we get pulled up the options chain for Costco at May 16th. So now we're going to look at the parameters we talked about, and we're looking for delta that's at least over 0.25 and the most liquid contract. So this one stands out to me right away because look at how much open interest it has. 1700, 148 volume, and way more than enough delta at 0.45. It's the 1000 call for May 16. This is the one that I'm going to trade. So this is kind of like a rough idea on how I pick the contracts, but ideally the sweet spot is a little bit out the money and taking about 3 to 4 weeks out on your plays, unless there's a huge base and then you need more time for the contracts to play out. However, I do want to make sure everyone understands that weeklies, 0DTs, meaning they expire the same day contracts, are going to be super, super risky. These are contracts that I would avoid and only trade once you have a lot of experience under your belt trading options. Assignment and exercise explained. So two very important concepts when you're trading options. Usually we don't want to exercise our calls, but we want to know what exercising our calls means. So exercising means you have the right to buy when trading calls or sell when trading puts the option contract that you traded. Assignment is when you're obligated to fulfill the options contract as a seller. If you're buying options, you're going to be able to decide when to exercise the contract. But if you're selling options, if you're in the money, you might get assigned before the expiration. Most traders will close their position before expiration to avoid the exercise of the calls or puts. That's usually what I do. I don't really hold until exercising the position. The only time you'd want to do that is if you want to buy those shares at a specific price and hold the stock for a longer period of time. If you're selling options and you're assigned, don't panic. It just means you have to buy or sell the shares at the specific strike price that you sold the contract for. Let me walk you through a few examples of trades that I personally took trading options. The first trade that I took was on the ticker Tesla. It was showing a lot of momentum as it was breaking out from this level right here, and I ended up buying calls on this. The stock ended up making a 14 to 20% move, but the contracts ended up netting me about 3,000 to 4,000% because there's so much leverage on the contract. So as they ran all the way up into these highs, I ended up making about a 3,000 to 4,000% return on this trade. And that really shows you the power of options. This is an example of covered calls that I sold on the ticker HOOD. This one was trading at $45. I owned 100 shares of the stock, so I ended up selling the premium against the shares that I owned. So I sold calls on this. As it dropped lower, I ended up collecting the premium. So with selling calls, we don't want the stock to get over this level right here at the strike price that you sell it at, because if it does, you're going to get potentially assigned. Let me leave you with what I've learned over my years of trading in the stock market, specifically trading options. Most beginners think that success in the markets will be because they learn every single indicator, learn every single strategy, learn every single ticker, but that's far from the truth. Here's what actually works. Picking one strong setup within the market, knowing the options, and the way that the options work on that specific ticker, keeping your strategy very simple, repeatable, and scalable. That way we could do this over a long period of time. Trade less, because less is more in trading. The more you wait for setups, the more you're patient to wait for the things that you know you should be doing as a trader, the more money you're eventually going to make while you trade stocks. Options trading is a very unique trading instrument that is going to be very different from Forex, stocks, futures even. Because of all these underlying things that we talked about in this video, that's what makes the trading journey of options very exciting. There's so much to learn about and there's so much to execute when it comes to trading options, and there's so much money to make if we do it the right way. You have the power to make a ton of money while risking a little amount of money. Just don't get to the point where you're full porting your account, making mistakes that you shouldn't be making, and focus on building the right foundation, learning how options actually work. And then once you have a winning strategy, we can start to implement more size into our trades and be able to be consistent in the long run. This will give traders who literally don't have big accounts, like $2,000, $3,000, $5,000 accounts, to be able to flip their accounts very quickly if done correctly. You're not going to have to buy thousands of shares to make, a big amount of money, because options have that leverage. And you can start with a very small amount of money to be able to make a lot of money in the future. This will give anyone the opportunity to learn this instrument called options and literally make your first 4, 5, or even 6 figures in trading while trading a smaller account. Anyone could step in, anyone could trade options and be able to do this. You just need to learn the foundations we covered today and then go on and apply everything we talked about in the stock market. Now, if you enjoyed this video, please hit the subscribe button and comment below exactly what you want me to cover this year. I'm going to be putting out a ton of content for traders and helping you become profitable. So until next time, I'll see everyone later. Bye.